Hi, everybody. Welcome, welcome, welcome. It's really good to see everybody here on this VC Lab webinar. Thank you all so much for joining us. We really appreciate it. My name is Mike Supervici. I'm the head of acceleration here at Desal Group. Desal Group is an organization whose entire purpose of existence is to help new and emerging managers thrive. Okay. And we do that in a variety of different ways. One of the key components of what we do is training. We do that through sessions like today, where we're going to talk about how to close on institutional LPs. We do that through various other programs. We have a VC Lab Accelerator. Many of you are sort of in the queue applying for the next cohort. Many of you are in cohort 16. The application deadline for that is the 3rd. We do that through products. We have a product called Desal Hub, which has effectively become the operating system for new and emerging managers. Over 700 active venture capital firms are using it. We have a back office tech-enabled service called Desal Partners that is kind of top grade, institutional grade, 94 NPS, has hundreds of VC firms using it. And we do that through capital. We have a fund of funds, we have a network of LPs, marketplaces to sort of move capital into emerging managers. So if you sort of just think about what we do is we clear the way and make the process of launching an institutional grade, enduring venture capital firm significantly easier as a result of all these systems and tools. But one of the ways that we try to do the most impact is through sessions like this, right? Where we, host webinars multiple times a week, just to help, the community get better at what we do, right? And we see a lot of people trying to break into this asset class, and we want to try to prevent any sort of mistakes that may come up, and we want to sort of bring everything together and help you get all the information that you need to be very successful at your craft. So today what's going to happen is I'm going to go through a brief presentation on how to prospect and how to close on institutional LPs. If you don't know what an institutional LP is, don't worry about it. I'm going to cover all of that in my presentation. This is going to take 20 to 30 minutes. Then once we're done with that, I want to take all of your questions. Okay, so there's a Q&A button at the bottom of your screen, and I'd like you to put your questions in there. You can upvote them, and I'm going to prompt you to do that throughout this experience for the next hour. You can also introduce yourself into the chat. I see some people already doing this. The one thing I will tell you though, please, just know that this is a public webinar. And so don't talk about your thesis. Don't talk about what you're doing. That's a general solicitation risk. And we'll put some articles on how to deal with this. So don't put your thesis in the channel, in the chat. Don't talk about like, hey, I'm raising this fund that's doing this, this, and this. That's illegal in many places in the world. And so avoid doing stuff like that. Okay. But you can say, hello, my name is Mike, and this is who I am, and this is my LinkedIn. I think that's perfectly fine. And we do want you to meet as many people as possible, because venture capital is, after all, a network business. Okay, so this is great that you're doing that. But if you want to learn more about general solicitation and what that is all about, we actually put an article into the chat for you that you can read. And so take a look at that. And final thing before I start sharing my screen and go through sort of what it means to sort of like be institutional grade and how to prospect institutional LPs and how to sort of think about this is, I'm not really following the chat. Okay, I'm not really looking at the chat. If you have questions for me, please don't put them into the chat. There's an actual Q&A button at the bottom of your screen, and there you can upload questions, and I'm going to go through those. So as questions come up throughout this presentation and things like that, just open up the Q&A button at the bottom of your screen. You may have to expand like the Zoom window to do that for some of you, and just go in and put questions in there so we can get going. All right, so let's get the show started. All right, everyone. Hopefully, everybody here can see my presentation. And I'll go ahead and get started. And I do see there's a question that did come into the chat about like, is this being recorded? Everything we do is being recorded. We'll be shared later and all of that. Okay, so No need to like scramble to take notes or whatever the case may be. Okay. All right. So the topic of the day is how to close on institutional LPs. But I realize that many people might not know what an institutional LP is. And there's also in this industry of venture capital, there's just a lot of information that's either not accurate or people misuse various terminology. One of the most misused things, for example, is an emerging manager. What is an emerging manager? Actually, for most LPs, an emerging manager is someone that's on fund 2, fund 3, or fund 4 sometimes. It's rarely people that start their first fund, right? That's actually called a new manager. So that's an example of that. Institutional LPs are no different, right? Like, what is an actual institutional LP? So institutional LPs sort of fall into several buckets. There are corporations that invest in venture capital, and they do this for various strategic reasons. That's often considered an institutional LPs. There are endowments that specialize in investing in venture capital. Many of them don't invest in emerging managers. I just want to put it out there. There's a few that do, but very rarely. But those are there's definitely some there. Pension funds, it's not uncommon for certain countries or for certain states or for certain type of organizations to have pension funds, and they sort of put this money across a variety of different asset classes in the private markets, including venture capital. Also, very rarely do they invest in emerging managers. Just want to put that out there for folks, just so that you know. And then there's a variety of sort of sovereign wealth funds that do this kind of stuff too. And so those are typically who are considered institutional LPs. Like right below that, I would say there's a whole bucket called family offices. We can talk about family offices if you have questions later, but this presentation is more around sort of how to think about institutional LPs. And the key is that even though many of you on this call are not going to raise money from many of the organizations that I've listed here, you have to be institutional ready from like day one, because everything that you do today is going to be diligence in fund 2 and fund 3 and fund 4 and things like this. And if you sort of don't do that really well from the beginning, you're going to have a really difficult time moving forward and building a firm. And it's at the point now where even the LPs that sort of come into fund 1s and fund 2s are thinking about this. Like, can you get to like the next fund 2, fund 3? Can you raise institutional grade even if you're not raising institutional capital in fund 1? So this is very, very important that you sort of do this right and sort of set up your organization to be able to pass diligence and be able to successfully close on these types of LPs, okay, which are incredibly professional and have a lot more and just more rigorous in general. Okay. If you don't take, if you don't like take any, if you just want to like remember one thing, okay, if one thing to say is that LPs, okay, want you to do what you say you're going to do. This is probably the most important lesson you're going to get out of today. Okay, so LPs want you to do what you say you will do. A lot of people say they will do a lot of stuff and then they don't end up doing it, right? And then they end up in a lot of problems. When an LP does diligence on you, they're going to look at the things that you've done in the past that you claim that you have done and see if they're in fact true and real and that you've been able to execute. So just remember that LPs, especially at the institutional level, want you to do what you say you will do, okay? And these relationships are very, very long-term, okay? And so what you want to think about this, like, I mean, talking very long-term, right? So let me just take a step back. Typically when an institutional LP is saying, hey, I'm going to invest in your fund, they're not just investing in one fund. They're going to invest with you probably for 2 to 3 or 4 funds. So that's like, each venture capital fund typically is 10 years with 2 years extension. So that's 12 years. That's 3 funds, right, of 12 years each. So you're looking at a 20 to 30 year relationship potentially, right? That's a long time. Okay. That's a long time that you are going to be working together. And so, they have to do a lot of work ahead of time to ensure that it's okay and they want to and it's safe, right, for them to sort of enter into a 20 to 30 year relationship with you. All right. And so, the way you got to think about this is that you want to sort of build maximum alignment to be able to help you ensure that you can build these long-term relationships and have the best probability of succeeding, right? And so you gotta be super candid with everything that you do, right? The minute that someone that's trying to diligence whether they want to enter into a 20-year relationships with you catches you in a lie, right? There, it's over, right? And so you got to be like very transparent about how you do things. You want to be show and demonstrate that you're very like rigorous in like your approach and how you run this farm, how you're basically a professional money manager that's going to be doing this as a career, and this is, you're going all in and you're going to be managing their money very, very well and ethically and professionally, and you're taking this stuff super, super serious, right? And so like on a high level, you got to start thinking about this from that perspective. Okay. When you're out uh fundraising, you know, a lot of the diligence that's going to happen, right, is going to be a lot on things you've done in the past, obviously, right? It's like, and it's not necessarily about the data. This is where I think a lot of people go awry with this kind of stuff. When you're at this level of limited partner, uh, performance is not enough. I have this conversations with new managers all the time, but I was like a very successful syndicate lead on Angel List, or I was like a, angel that was just very, very successful. Like, isn't that enough for me to be successful at this next level? And the reality is it's not really, because at this next level, you need performance and predictability, right? The number one thing is always going to be performance when people make these investments, but 1B, okay, so that's like 1A, 1B is how you've been able to administer the entire operation of your fund. Okay. Like, how excellent are your operations? Um, how have you been able to sort of deliver on the expectations that you've set? Remember, back to the kind of component at the beginning, just say you're going to, do what you say you're going to do, right? And how successful your team is, right? And these are absolutely critical. If you do not have operational excellence, like, you are not going to be able to scale beyond sort of like high net worth individuals in your fundraising ever. Okay. Because again, these are like 20-year relationships. And if someone is going to say, I want to do a 20-year relationship with you, I want to make sure that I'm going to be able to get reporting on time. I'm going to get my taxes on time. I'm going to be able to like know that you're managing this fund in the most ethical manner possible, that you're not going to do bad stuff. And, just taking a step back, just think about who these people are, right? Like, for a lot of you that are probably already out in the market fundraising, you're pitching a lot of like high net worth individuals. They're making like their own decisions. It's like their money. At this level, you're pitching employees, right? These are employees of pension funds and sovereign wealth funds and all this other stuff. And so there's tremendous risk for them, right? If they make a bad decision here, they're not only going to be out of a job, right? But they probably will never be able to get a job in the industry. Like, if there's any sort of like bad behavior or fraudulent behavior that's happening within the operations of your fund, or just basic ethics issues, you know what I mean? And they find out about this 3 years in or something after they've decided to commit to your fund. They're going to stop making capital calls. They're going to not commit to your next fund. And that person that made that decision to invest in your fund is probably going to get fired, right? And so, like, all of these things like matter, and I'm just trying to help you understand like why this is the way it is. Okay. And I don't make the rules. I'm not even trying to claim one is fair or not, that kind of thing. It's just, these are the conditions on the field, and you have to be optimized to ensure that you succeed under those conditions. Okay. So let's go a little bit deeper on these topics, because I do think they're sort of important, right? So, again, this entire kind of like LP base, thrives on predictability. Okay. They need to ensure that your stuff is predictable. They don't want to like have to worry that you have some sort of like compliance issue. Okay. They don't want to have to worry that your bank just got shut down because you took money from an LP that's on the sanctions list or in a sanctioned country, or because you took wires from an account that did not match the legal agreement, which, whether is right or wrong looks like money laundering, right? Like they don't want to deal with this kind of stuff, right? They don't ever want to have to fix this kind of stuff, even if you yourself, for you, this was like an innocent mistake and not evil or anything like this, right? So under sort of like the operational excellence bucket, you have to have super institutional grade operations for your firm. Okay, so one of the things that the emerging managers that came before you totally sort of messed up on and actually raised the bar for you to clear as a result of this is that most of them didn't really have compliance, right? So compliance means you know who your LPs are. That's typically done by KYC and AML, but it's also make sure that all the wires are tied out directly to legal agreements. So for both into your fund and out through distributions, and then you have some sort of a policy that does this right. And we'll talk about this a little bit later, but this is absolutely critical. And a lot of people that came before you just wouldn't do that because they would sort of get a fund administrator, fund admin, and typically fund admin just means accounting and filings, right? There's no like compliance layer at this at all, right? Ethics, right? I see there's some cohort 17 people on here. This is the number one reason why we make you share the Mensarius oath publicly and why we think it's absolutely critical that you do that, because we only want to work with ethical VCs. This industry historically has been riddled with unethical behavior. It's been sort of like a cottage industry where GPs do all sorts of unethical stuff, and not necessarily because they're unethical, because they just simply don't understand that like a decision that they've made was unethical. I'm going to give you a very sort of basic version of this, right? Like you're a prominent angel investor, you just raised the fund and you're like, hey, I want to double down on this one angel investments that's breaking out with the fund. Well, that's actually a pretty serious like ethics issue there, right? Because you're effectively self-dealing, right? You're going to like help yourself a little bit by marking up this investment with the fund, right? And so therefore you need to go through a proper process to make sure that that's okay, such as a limited partner advisory committee and doing this right. So that's like a more benign issue. But there's like actual serious issues, like you gave an LP a side letter, and you didn't disclose that side letter to all other LPs. And that side letter, because you did that, actually materially impacts the performance of the fund. That creates a lot of problems, right? So how do you deal with this? We've seen issues where emerging managers are putting LPs on different capital call schedules. So they'll take like 100% of one person's money, 25% of another person's money, and try to put it into a company and do bad stuff like this. And that's just horribly bad, right? And that's a pretty serious ethics and sort of fiduciary issues. And obviously everything else like governance, and you're going to have policies and be super like institutional grade. And we're, if you're going through VC Lab, we're going to help with this. We have sessions on this. If you work with us in the back office product that we have, this is all sort of covered, but it's important for everybody on this call to sort of understand just how critical this stuff is. Like you can't administration and how you think about investor relations is like 1B. Okay. The second thing, and this is where we see an enormous amount of issues when people go to this next level, is sort of strategy alignment. Look, you're going to be doing this for 20 years. It's a long time, and LPs are trying to figure out if they want to work with you for 20 years. And it's so critical that you both align on expectations. And sometimes what happens, especially when there's a lot of money at stake, people compromise on stuff, right? Like, so for example, I don't know, you might have a thesis that invests in, deep tech somewhere, and an LP comes to you and says, look, I'm in for like 3 million, but I actually kind of really want you to do more investments in Southeast Asia. And that's where I want you to deploy my money. That is a pretty serious, misalignment of expectations there. And because it's an enormous amount of money for a lot of you, you're like, oh, well, maybe I should rethink this. Maybe I should rethink kind of how we invest with this fund and do all this stuff. Like that can't happen, right? Like there needs to be maximum alignment of expectations. Otherwise, it's gonna be an absolute disaster, right? Like I said, if you don't, you may not be motivated to do this for next 10 to 20 years. You may make bad investment decisions because of this, and so on. And LPs are going to get upset and it's going to create a lot of problems for you, right? And so it's really critical that you and the LP is aligned on expectations here, because your life's short. Life is short, and it's not worth you doing something you're not passionate about, right? And finally, you have to be super transparent about reporting. Like, one of the biggest issues right now in venture, for example, and why LPs are, especially at this level, are very upset, is that a lot of investors are marking up their companies on various different standards, right? So one investor will have one type of valuation policy, another investor will have another valuation policy. So imagine this from like the institutional LP level, right? So you invested in like 30 funds or 50 funds. It's very likely that you probably have at least a few portfolio companies through these funds where two or three of your portfolio funds have invested in, and the value of each of those companies is reflected differently in each of these reports. Okay. And that's bad, right? Like, it's just, there's like no standardization there. There's just no policy around it. And part of it is because a lot of people are not taking this process very seriously. So that's one example. Another example is, just around basic stuff like tax, right? It's not uncommon for many administrative providers to send out K1s to your LPs in the fall. That's not great, and so you really want to make sure that people can do get their stuff out as early as possible, ideally in this quarter, right? And again, the whole point of this is like predictability, right? Like, I want to be able to read and understand the metrics of your fund, and that you're doing this really well and it's really professional. And just taking a step back before I go to sort of like the next slide on this, even though you're sort of like a startup, you're no different than the startups you're backing. For many of you, right? You have like these funds that you're growing, and you're an entrepreneur yourself. You're raising a fund and all that. You're still not that different from like a Fidelity, okay? You're like running at like a smaller scale, right? But you need to operate almost like a Fidelity when you go out and you're committed to managing people's money for 10, 20 years, right? And so you need to have the controls to allow for that to sort of happen. Okay. All right. So let's talk about like how to basically ace institutional DD, right? So you're going to need all these 6 things that I'm putting in here, and what I'm going to do is go through each and give you some thoughts on all of them, and then we'll start kind of moving over and getting into questions. And so get your questions ready. Okay. All right. The first thing you're going to need at this level is like a super robust data room. Okay. And this is not something you put in Google Drive, everyone. I want to be clear. This is not a Dropbox thing. You need like a professional data room platform. Decile Hub does this. There's some other tools that do this, because you need to be able to control who gets access to what. And I'm going to talk about that in a second as to why, but this is not something you do in Google Drive. I want to be very clear. You have to be able to control who accesses what file and when. Okay. And this is going to have like your financial model, all of your legal docs, portfolio, research team. And then most importantly, you're going to have deal memos on each of these companies. Okay. Now, for many of you that have come from like the angel and the syndicate world, a deal memo for a VC fund is very different. Okay. What you used to do when you're like building out a syndicate, you would write this deal memo that's effectively marketing to be able to get more LPs to kind of put money into your syndicate. Okay. And you typically work with the founder on it too, right? In the world of venture capital, in the world of you being a professional money manager, that's not what the deal memo is. Okay. The deal memo is where you're documenting your thinking about why you're investing. You're documenting everything, all the risks. You might say, I don't know about this founder, or whatever the case may be, right? This is very personal stuff. So back to what I was telling you before, why you need a very professional data room with control. Like, you can't have this private information about a company and the founder like be circulated around, right? Like, you can't have that. Like, you can't, like, if that gets out, right, and the founder finds out, like, your reputation is tarnished forever, and this is like a reputation business, right? And so you only make stuff available when like a certain LP asks for it. This is why you need to make sure you have a very professional data room to do this. Okay. Second, absolutely critical. People are going to diligence the hell out of this, which is basically compliance, right? Because again, a lot of people got burnt because a lot of emerging managers that came before you didn't take this part seriously. And unfortunately, you're going to have to be at a whole nother level on like compliance. All right. So they're going to look at what's called a compliance policy, right? It's like, how do you onboard LPs, right? Like what steps do you go through to KYC and ML? If there's a problem on KYC and ML, how do you handle that, right? Are you taking people into the fund that have had other issues that maybe didn't show up, like on KYC and ML, like, I don't know, like lawsuits or whatever? Like, how do you deal with that, right? This is very important. You're going to have a process for dealing with conflicts. I gave you some examples earlier about some potential conflicts. How do you deal with conflicts? Because there's going to be all sorts of conflicts that are going to happen, right? If you're going to have 2 to 3 or 4 funds, how are you going to deal with investments you did in fund one and invest that you may want to do with like fund two or whatever? Like, how do you deal with that, right? Like, those are like really important, right? And so you're going to have documents that kind of show how you think about all this stuff. Okay. You're going to need an LP advisory committee. Their job is to basically like set up like, to clear conflicts. And this is why for many of you who are doing like fund ones right now, this is why you need to do it in fund one, even though you may not have institutional LPs in that one, because you're sort of setting up the process and people are going to diligence how you did this stuff in fund one, right? And so you need to be super on top of that, right? And of course, everybody has to pass KYC and ML, right? Like GPs, LPs, like everybody, right? This is like a super like button down, like institutional grade operation, even though you're sort of like a startup, okay? Startup fund. All right. Then what's going to happen is people are going to do like operations DD on you, due diligence, okay? And, they're going to try to understand, right? Like how you've made these investments and how you've managed those investments moving forward. So a lot of people that get started in this, they think it's just about sort of investing, right? Because when you're an angel, right, you can just make these investments and then like, yeah, if the founder doesn't send you some updates, whatever, it's not the end of the world, right? I mean, it's not great, but it's not like the end of the world. Okay. When you're a professional money manager, you need to get updates from those founders forever, right? Until the company's like shut down or acquired or went IPO. Okay. Because you can't mark up investments unless you have proof, like actual signed legal docs, not like a screenshot of the cap table or something, like actual like legal documents that they did a price round and this is the price per share. And many of you who are angels on this call probably understand why this is hard, right? Because you're like a small check, 100 grand. The company just raised $100 million at $1 billion pre, and they're like, hey, I don't care about the small angel, or I don't care about this. I'm not going to send you this stuff, right? But you're going to have to. It's part of your fiduciary responsibility. And these LPs are going to want to know that because they're going to need to see those reports. They're going to need to see how things are getting marked up. They're going to need to see how the performance is going, right? And so all those sort of end-to-end like operations need to be very robust, right? To be able to kind of clear sort of like the next like step of diligence. And people want to make sure that you're dealing with this right, very transparently. You're dealing conflicts of interest, handling all of that very well. And if you do that well, you're going to be able to generate very consistent quarterly reports, right? So that means quarterly you're getting updates from all of these companies. Quarterly you're able to sort of mark things up if necessary, that kind of things, right? And that is critical, right? This is basically why they're part of the reason they're investing in your fund is not just performance, right? Is also just to get information, right, on the market, on how things are going and things like this. So your ability to sort of communicate quarterly and monthly with newsletters and they're going to want to see that, right? So they're going to want to look in your data room for previous quarterly reports that you've done, previous newsletters that you've done, to see what this relationship might look like for like the next 20 years, right? So just think of it like that when you're sort of kind of working through this, okay? Then what they're going to do is they're going to try to basically like diligence your back office. I'm on the receiving end on this because again, we have a very prominent sort of back office business as part of Decile Group, and I'm constantly doing diligence calls with limited partners at this level about like how the back office works. right? What is going on? How are they handling things? What are they, you know, who does what, right? And are they providing timely reports, taxes, and all that other stuff, right? And so you have to work with a very reputable provider here, and this is not the place where you can cut costs. And I know everybody here is a startup effectively, so you don't have a lot of budget. But I can tell you, like, if you don't have this right, you're effectively taking this entire asset class of LPs off the table, right? And so you have to work with like a reputable provider that is very good at this. And there's a lot of providers that are sort of like high volume right now that have a very mixed reputation in the market. Okay. To the point where some LPs are saying, oh, you have that provider in. Okay, I'm not going to invest in your fund. Okay. And we're not going to talk about that. I'm not going to name names on that right now because this is a public webinar. If you're in VC Lab, though, we go very deep and we make all of that sort of transparent, right? And so just be very mindful of that, right? Talk to other GPs, do your diligence because this is absolutely critical. Then you're going to have to be ready for reference checks, right? And so at this level, LPs do extensive reference checks. I'm talking 20 references kind of thing, right? We have a fund of funds, and our fund of funds basically follows this process as well. And even us, right? And think about where we are sort of in this market, right? We have probably better information than any LP in the world for investing in emerging managers, right? We have roughly 3,000 to 4,000 people apply for each cohort, right? We run an accelerator and we help, hundreds of managers, and we see their performance through the accelerator. We then do the back office and, empower the vast majority of the best ones already, right? And so we have a level of like fidelity of information on pretty much every like manager that most other fund of funds don't. And even in our case, we're doing 20 reference checks per fund, right? So you got to be ready for this, right? And half of those references are going to be references that you provide. The other half are going to be off list, right? People are going to try to find out other stuff. So if like you've treated a founder badly, that's going to come out in diligence, right? If you treated a limited partner badly, right? That's going to come off. That's going to come into that. It's going to factor into diligence, right? Because people are going to want to talk to your LPs and want to understand sort of what this is like. And it sort of makes sense. Back to taking a step back, right? Taking a step back, it makes sense, right? They're trying to build, they're diligencing to ensure that it's okay to have a 20-year relationship here, right? And you would do the same thing if you were them, right? Like you're not going to just enter into a 20-year relationship with like without a lot of stuff. And yeah, and this takes time, right? Just like it probably took you time before you decided to get married or something, right? Like it's not that different from if you sort of think about it this way, right? And so like all the stuff that I'm telling you here, though, what kind of brings it all together though is you have to be committed to building like a long-term sort of like enduring firm, because if you're like committed to building an enduring firm from day one, you're going to take all these responsibilities very seriously from day one. And then you're going to build out everything correctly. You're going to have like institutional vendors, right? You're not going to mess around and try to like, oh, I'm going to like cost cut here and cost cut here. And then like make this like this, right? You're not going to cut corners, right? You're not going to cut corners on operations because you're like, I'm trying to build this very like robust institution, right? And you might not take LPs that don't agree with your mission, right? You're going to say, look, this is a long-term thing I'm doing. I don't want to have to deal with this LP that's going to be a pain in the butt for me for like the next 20 years, right? And so you're going to kind of ensure that you have everything dialed in and ready to go. Okay. Final thing here, like I just want to leave this up here for a little bit longer, just so everybody sort of soaks in. Look, institutions demand predictability and performance, right? And so you can set up the conditions, even if you don't have a lot of track record right now, or you're just getting started with a fund one, you can set up these conditions now so that you can be in a really good spot moving forward as you continue to kind of grow your firm, okay? So with that, without further ado, let's go ahead and get into questions. I see quite a lot of questions are coming into the Q&A. Everybody, there's like an upvote button, looks like a little like, thing. I like that. So, put up your questions, upvote them, and then I'll go ahead and try to go through all these questions and try to get to as many as possible. Okay. Are there any best practices about how much managers should invest in the fund when approaching institutional LPs? Typically, LPs, it doesn't matter if they're institutional or not, and expect at least 1% of the fund to be invested in by the general partners. Okay. That being said, it is it's over capital calls, right? You don't have to come up with the money right up front. If you want to sort of calculate what this would look like for you, sort of on like a first close or something like this, I recommend you go to Decile Base, so Decile Hub /base, and type in something. Hey, I'm raising a $10 million fund. I'm going to make a 1% commitment. What will I be expected to wire, assuming I'm going to make a 25% capital call? Something like that, right? And then you sort of see like kind of what that looks like. It's pretty manageable if it's at 1%. Given that most of us starting out and may not have a partner GP already, is there a rule of how many GPs you should have to raise certain amount? Say, for example, it's a microfine $5 or $10 million first fund. No, there's no rule. And actually, Gopon, the risk of a team breaking up, and this is going to come up in diligence quite a lot, is significantly higher than you getting hit by a bus. Okay. And because of that, good LPs that know what they're doing, professionals that have been part of this, or we train a bunch of LPs too. We have a program where we just train LPs, for example, and we talk about this. When managing partners break up, this is the difference between what you're doing in a startup. When managing partners break up is death. The firm dies effectively, right? And LPs might stop making capital calls, right? Probably will stop making capital calls. It's really, really, really bad. Really, 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 really bad. Okay. This isn't like a startup where it's like, I need a co-founder because and there's like nice vesting schedules. And no, you're owners, right? You're owners of the management company, you're owners of the funds. And so you got to be super careful about this. So don't like try to hack around this as like, I need X amount of partners. Instead, what you want to do here is start solo if you don't know people very well and haven't worked with them for extensive amount of time. Everything I've just talked about here. Remember when I said institutional LPs 120-year relationship? You got to take the same approach to partners. Okay. Because you all are going to be working together for possibly like 20 years. And so you can hire people and promote them in each fund, maybe start them at principal level. And if they're good or whatever, bring them into the management company. But I'm telling you, like, if you don't know people very well and haven't worked together for a very long time, you really don't want to start a fund together like this. And this is why, for all the cohort 17 people that are on this call, we tell you to bring your partners in. We tell you to bring your partners in the program because the program is going to stress you out. And it's going to test those relationships quite a lot. And you're going to figure out if people like want to do this for a long time or not. And we're going to be able to deal with this before you go out and form the fund and possibly do a first close, which is going to be an absolute disaster if you started a fund with people that that weren't committed from the beginning, right? So that's why we do it this way. Okay. All right. Is there a standard format for deal memo and what should be included in the same? There isn't really a standard format. Everybody's a little bit different, but there is, what VC, some of the more old school VCs have done recently is that they started setting up, like putting out like their memos that they did from like a long time ago, Nia. So in the chat here, let me, all right. So, there's let me see here. I can't do this. I'll have my coworker put this up here. So I'm going to just go ahead and put this in for everybody because I can't put his stuff in the chat. But for example, Bessemer put out a whole bunch of their memos and stuff, and you can see sort of like the detail here. They're going to put it up, so you can kind of see the level of like detail that you need, because you're going to refer back to these memos, and these are going to make you better investors, right? So we'll put those in the chat. Okay. All right. For first time managers, shall we start building relationships with fund of funds early now, even if we don't have all the things you outlined yet? I wouldn't do that right now, Maxim. So if you're a first time manager, you should go into like a VC lab and start working on stuff together. Because the thing that's going to happen is that you kind of have like one time to make a good first impression. And most of these fund of funds will never do your first close. I mean, that's like the riskiest kind of investments you can do. New manager that's never done this before, and like a first close, they've never done this before, right? So what they'll usually do is wait till like you're a year into your fundraising and have like raised most of the fund, and that's when usually they'll come into a first fund. And most fund of funds are prevented by charter to invest in new managers as well. So you got to make sure you work with fund of funds like ours that like specialize in new managers and that kind of stuff, right? And you're just not going to be ready for that, right? This is why it's so critical that you get to like this first or second close, often a first fund. You kind of set up these operations to be sort of institutional grade, so that when they go in, you can kind of like go through diligence and as good as possible, and not have hopefully any red flags there, right? And so what you want to do right now, Maxim, is go through the program, start building out your thesis, start getting commitments, maybe even do a first close on your fund. And then you can start ramping up those relationships over time and just sort of keeping them updated. That's what I would say would be like the best thing to do. If you go too early, you might lose that, opportunity. We have seen data rooms built in Notion. Is that recommended? I don't think in general, you really do not want to put together this VC stack. Okay, this is a huge problem right now. A bunch of managers are putting together Notion with Airtable with with like a Zapier integration. Guys, like this is like a pretty serious, first of all, security risk, obviously, because you're like dealing with this through Zapier, and it's going to create problems for you down the line, because again, it's hard to lock down some of these things like I talked about. So is it possible for you to do your memos in Notion and lock them down? I guess it is, but it's kind of complicated, right? And so what I would do is I'll try to build like a better system for that, for those memos. And I would put them into a data room, and whether you draft them in something else like a doc, like a Word doc or something, or you use a system like Hub that actually has a deal memo functionality and capabilities that puts them securely into like a data room that doesn't get exposed by a whole bunch of security risks. Like that's how I would sort of deal with this, right? Versus like trying to put together like Notion with like Airtable with like right? Like that is kind of like a thing in the past that people just sort of had to do because there weren't any better alternatives. Right now, I would just use Hub. I mean, it's free, right? And there's no risk to you for using it. Any perspective on out of boxers? So Alvar, I do not want to talk about this in a public webinar, right? Because like the things I'm going to say about most of the stuff you are talking about here is not going to be very good. So I'm just going to like leave it at that. But I would not, you need to work with institutional grade providers, right? Institutional grade providers. And oftentimes, even in admissions, when we see that people are not working with institutional grade providers, we just won't work with them in the program because it's too hard to fix this, and many of these pseudo institutional grade providers have super unethical practices. Okay. Like I'm talking like engagement letters that lock people in for 3 years that you can't get out, but you didn't see the fine print on page whatever 15. And it's even harder to fix this issue. Right. And so what I would just say is like, make sure you're working with institutional grade providers. What are the most common mistakes GPs make when pitching to institutional LPs? Well, they don't have their act together. Like that's the number one, Mohammed. Like, for many people, when you sort of like they may have not been exposed to a presentation like this that's been sort of very stern and very to the point, right? So they don't have their act together, and then basically they get hit with what's called a DDQ, a due diligence questionnaire. And for those of you that have never seen a DDQ from an institutional LP, it's like 30 pages of like questions. Okay. What's the cap table look like? How much ownership does everybody have? It's like deep, deep, deep level of stuff. And then what ends up happening is that people have to scramble, right? They have to scramble to put all this stuff together because you can't take a month and get back to them after you got all this crap together. And I'm telling you, this, like what I just put outline here in this deck is a lot of time, right? That's why we, in the program, we sort of do it very systematically. We like drip it through the process so that you kind of have everything while you're also pitching LPs and stuff like that. And so, you know, you do not want to get caught like this. So that's number one. The second thing that I see, and this is why I've been so like stern about this, and part of it is just because I'm genuinely pretty frustrated about this personally, is that again, many of the GPs that came before you kind of messed up the market for you all, right? Because they didn't have compliance and they didn't take compliance very seriously, right? And then, you know, banks would shut down their bank account because they took an LP from like a sanctioned country, or they did really bad stuff with regards to like wires and not matching them to legal agreements and stuff like this. And this, of course, the LP discovered this in diligence. They're like, I'm never going to invest in an emerging manager ever again because they do bad stuff like this, right? And so don't do that, right? Take this like super serious, be very institutional grade from the beginning, and then you're going to have to like take it to the next level on this, right? So hopefully that's helpful. How do we approach your fund of funds? Go through the program is what I would say is the first step. That's how we work through that. And again, we generally want to see you be operational. I've done at least the first close. We give priority to people that we power because they're significantly safer and have a pretty significant competitive advantage over people that we don't, right? For lots of reasons, just because, we're making a lot of the process a lot easier and so on. So, but that's what I would do. Go through the program is probably the first place I would start. What are the best practices of managing expectations and conflicts with institutional LPs? Well, I think you need to understand why the LP is trying to invest in your fund. And where this becomes a pretty serious issue, right, is, for example, with foundations, right? So foundations rarely invest in funds for performance, right? They invest because they're trying to move some sort of initiative or something that their constituents care about forward, right? And so let's just say it's ESG or something like this, right? They're going to have reports back to their constituents that the stuff that they've invested in is hitting these sort of ESG milestones. Okay. Which means what? Which means that they're going to make you get this information to them, right? Which is an enormous amount of work. And which means that you're going to have to burden the founders that you invest in to get this kind of information as well. And as a result of that, you're probably not going to have the best founders work with you, because good founders are gonna be like, no, I'm not gonna like report on ESG for you, or whatever the case may be, right? And so it creates sort of like this misalignment of expectations, right? So this is like, I'm trying to be, I don't know, I'm exaggerating slightly here, but I'm trying to drive a point home of how, like, when you don't have alignment across the whole stack from LP to GP to founder, like things can get really out of whack. And money talks. And many of you on this call are in emerging markets where if someone comes in for millions of dollars, you're like, whoa, that's more money than, than like my market support. You may consider making some of these compromises, but all those decisions have some consequences, and I think you need to be aware of them. That doesn't mean you shouldn't do it. Okay. I just want you to understand like the potential issues that may come up as a result of not having a maximum alignment of expectations across the entire sort of capital flow. Okay. Sarah, hey, Sarah. What general diligence processes for family office? Do they also need very robust data rooms, 10 reference checks, et cetera? So family offices come in three types. Okay. So you've got what I would call like the startup family office, basically high net worth individual that has come into a pretty significant like liquidity event to the point where it's so much capital that they actually need to hire somebody or an organization or something to kind of manage that money for them. So these are like smaller family offices. They typically have like one person that's either full-time or part-time managing their money. And the investment decisions are still made primarily by the individual that made the money. So they're like high net worth with more process and systems, if that makes sense. The next level up are what I would say more professional family offices. They're like managing $200 to $500 million, right? And they actually have a team and they're deploying that capital across a whole bunch of different things. And then the next level above that, where you're managing even more money than that, are what are called multifamily offices. Okay. And multifamily offices are managing so much money that they actually, you're going to need to go through a process like I've outlined here for multifamily offices for sure. Okay. They're also tend to be extremely conservative because, again, they're like a business that manages money for a bunch of individuals. So they're very sort of like risk averse, and typically they don't, you typically emerging managers do tend to struggle with those. So you're going to do best with like the first type and the second type. Now, you're still going to need a robust like data room, right? Like no matter what. It's just that your data room is going to be different from like, let's call it the first type of family office than it is for like the multifamily office. The first type of family office typically invests in funds like yours, especially like yours, Sarah, is because like they want deal flow. Okay. They're seeing the emerging managers as like a source of really interesting investments, and they want to be able to sort of double down on like the best ones and through pro rata. And they sort of know that these first and second time funds typically don't have a lot of reserves, and they tend to syndicate and give their pro rata to LPs, right? And so what you sort of want to do is make sure that you optimize all that stuff for them. And when they are going to do some references, but they're primarily going to be like founder references, right? Whereas like the institutional level, like or the multifamily office is going to not only do founder references, but they're going to do also LP references. They're going to also do back office references. They're going to do like compliance reference, like all sorts of stuff, right? They're going to go through as part of this process. They're going to do legal DD that's very, very extensive, right? Whereas like at this level, you might not have so much. Often what I see at this level is like deal flow, a little bit of legal DD, because they often have like a part-time lawyer that helps them out, and that's about it. All right. I think you might have mentioned this in the past, but if an institutional expresses interest in becoming an LP, can we approach Desal Group about coming in as well via fund of funds? And you can go through the deep with us first to learn. Yeah, as a matter of fact, Melissa, we've actually set up a process now where all the partners that we work with, we do the back office and things like this, when they're sort of like ready to go out and start raising an institutional grade process, we do actually have you speak with Marco, who leads our Desal Capital initiative. And it's kind of a win-win. It's a good opportunity for our fund of funds to get to know you, but it's also an opportunity for you to make sure that you're doing good. And we're actually investing very heavily in this, right? We're investing very heavily into like emerging manager systems, programs, and things like this. So more on that to come, because many of the uh, uh, people that came through our first programs are now going on to fund 2 and fund 3, and it's a different level of like diligence. When it comes to portfolio construction, what is the typical range of deals a fund should target? When it really, I can't answer that question because it's so dependent on like your stage and your strategy, right? Like a pre-seed investor, because you might be super early, you might need to do 30 to 50 deals, right? Because most of them are going to go zero. Whereas like a Series A investor may get away with 15 because there's a lot more in stuff like that. The other thing that affects it too is like where the region that you're in, because there's higher degrees of failure in say emerging markets versus like say Silicon Valley. There's things like that happen. On a high level though, and this is very general, like don't quote me on this like this is the law, because it's not. Typically what we see in seed funds is like around 25, And what we see in pre-seed funds is like 30 to 50. Okay. All right. How many reference checks per GP? Again, typically it's on the firm. Okay, it's not on the GP. Some of you, because you are solo GPs, you are the firm. But typically what we see is 10, at least 10, most likely 20. And half of them are going to be off list. Okay. Everyone, there's lots of people on this call, lots of questions coming in. Start upvoting them. There's like 4 minutes, and I really want to get through as many of these like most popular questions as best I can. Okay. Do you recommend making institutional feel it's less risky by buying key man insurance to answer questions on what happens if you get sick, succession planning? There's not really any key man insurance, everyone. And you, Dr. John, I'll be straight up with you, man. If in the United States, you won't even be able to afford this, right? Because most of these providers are not built to deal and work with emerging managers, right? And so that's not gonna make people feel safe. What's going to make people feel safe is you having the operations and the conditions to allow for that to sort of get done really well, right? What happens if there's an issue like this? Like when the fund there's a thing in your LPA called limited operations mode. The fund goes into limited operations mode. What do we do then? Who manages that? Is it us? Is it your back office? Like Best All Partners? In our case, we've had this situation happen, so we've had to manage this, and it was like relatively smooth given how bad it was obviously for the fund, right? And so that's where you mitigate this risk. You don't mitigate it through like legal docs. You don't mitigate it through insurance. You don't mitigate it through that. You mitigate it through systems and process that are very professional, and that's where people do a lot of the diligence. You know, what is a typical capital structure? I'm not really sure how to answer this other than to say that, you know, typically most of the, you know, most of these LPs are looking for very specific kind of structure for these firms, which are like Manco, GP, and LP. When you get off that and you don't do a sort of a classic, like what I would say 2 and 20 funds and things like this, then is when you start having issues because they're just not used to it. So now all of a sudden you take what I just put up here on the deck, which was hopefully pretty robust, right? And you got to go to a whole nother level because this fund invests differently or whatever the case may be. So, you know, 3 entity structure is what I would say is at the very minimum in 2 and 20. How important is the territory of the fund? Yes, very important. You know, Luba, very important. You know, that being said, I would say like most people are putting their funds in Delaware, unless you're sort of in Canada, which it makes sense for you to put it in Ontario, which is a very friendly place for international LPs. And the other thing you got to think about, Luba, is also just affordability. Like you're just not going to be able to afford, you know, Cayman and these sort of like offshore entities. It's just impossible unless you actually have the ability to raise $50 million, which most emerging managers just don't, right? And so you got to sort of balance that out. But Delaware is very safe, right, for a lot of people because it's got a good market. It's really inexpensive, and then it's just a matter of who you work with on the back office. All right, 2 more questions and then we'll wrap. What are the most significant factors institutional LPs consider when deciding to invest in a VC fund? Well, I just outlined a whole bunch of them, right? Look, I'm assuming that you all have you know, have some level of like performance that you can talk about. Obviously, you know, no, you wouldn't do this, right, if you didn't have some sort of an edge. You wouldn't think about doing something like this unless you believe you can perform really well. So I'm assuming that that's table stakes, right? You need to have all the stuff I've outlined in this deck, right? To be able to have a shot at getting through a process like this. And this is going to be long. It's going to take like 9 months. Sometimes we have a situation right now with one of the funds that we're powering. It's been 13 months. Now it's been a lot of money that they got as a result of this, but you know, it's a lot of work, right? Because it's like, again, you're building a 20-year relationship. So it should take a long time for people to diligence you, right? So they're going to look to that you have like your ops and everything sort of in order and you're very predictable reporting. And of course, they're going to want to see that you've been able to make some good investments, right? So fund one, okay, fund one is basically about the GP, like who you are, what you've done. Fund two is basically about the logos in fund one, because you're not going to have like DPI, you're not going to have returns. And if you have returns by fund two, they're probably not going to be your best returns, right? Because your best returns are going to take like 10, 15 years, right? And so that one tends to be okay-ish because, like a lot of your fund one LPs come in, they believe in the mission and all that. Fund three is about DPI, okay? You're going to need to start showing some performance in fund one to be able to raise fund three well, right? That's typically how that sort of the cycle works. And that's why it's important that every decision you make in fund one, you got to think about it like, how is this going to affect fund two and fund three? And we cover a lot of this stuff in the VC Lab program, and we help you set up on the right track for that. So how prevalent is a requirement for ESG with institution is not. It's some do, some don't. I just use that as an example, Michael. I was trying to show kind of the alignment or misalignment and how it could come together. Final question: if I have an LP who invested in fund in my fund, who goes in and invests in a startup that the fund invested in with the intention, is this a conflict of interest? You're gonna set up the conditions for your LPs to do this kind of stuff. Okay, so basically the way it's gonna work is that many of these fund ones are very small, and you're not gonna have the ability to double down on your winners. Okay, just because your fund's small. So you're gonna like syndicate that out to your LPs first, either via an SPV or some sort of co-investment opportunity, and then you're gonna do that. And that's a really big benefit for LPs, right? Because you're effectively the scout, and all the best companies that are sort of breaking out of the fund, they could actually double down on, and you've done an enormous amount of diligence. So that's typically how that's done, and that's how it's done in a way that mitigates conflict of interest. Now, if you go out and you do this SPV and you don't give your LPs first shot at this, that's bad. There's an audit trail for that. That's going to be documented. Your LPs are going to be upset, right? This is going to come out in diligence. It's going to come out in your reference checks, right? And so this is how all this stuff can propagate in a really bad way for you. So if you just do things right from the beginning and very ethically, you're going to be okay, and you're going to do things the right way. All right, everybody. Hopefully this was helpful. I do have to wrap. We do have a hard stop here. For those of you that are thinking about coming into VC Lab 17, again, February 3rd is the deadline. Apply. And this is what we do, right? VC Lab 17. I can't believe I'm saying that, right? So we've helped hundreds and hundreds and hundreds of firms. I personally have helped hundreds of firms, right? And so we're here to help, man. This is what we're here for. See you on the other side. Bye, everyone.